Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters and Associates, a financial services firm here to help business owners navigate the decisions they face every day.
We have breaking news. Straight from Judson and I, the IRS announced the first of the new limits for 2026. We're going to run through those, and then we're going to go back to the basics with a quick refresher on one of the most powerful forces in finance, compounding.
I've never been so excited. Let's go. Okay, Hunter. So today, the IRS dropped its first of many updates for 2026, the inflation-adjusted amounts for a few items. And so we're gonna announce those today.
That's right. And before we don't have the IRA limits increases. We don't have 401ks. But before we do, Judson, we need to get our $500 button.
Yeah, we do. We haven't had it out in almost a year. So
Producer EJ needs to add that, and then our $526.50 for the HSA.
100%.
That one's always funny. Yeah, we got the. I mean, this is before we recorded, maybe a couple hours ago. And folks, this is not a ton of breaking news. There's a little bit here, but it's a good reminder that we'll be in front of you with all of the things as they drop over the coming weeks. We're now at weeks because we're in October, right? You want to do standard deduction? That's an easy one to start with.
Probably the most important one that we have for you today. The 2026 standard deduction increases to $32,200 for couples filing jointly. You divide that in half, and you can figure out what it is for a single individual. That's $16,100.
And honestly, that's kind of more. When I told you that in the hallway a second ago, we were both kind of shocked.
Well, it's because they hadn't gotten out their $500 button yet.
Yeah, they got the $1,100 button.
That's
out.
right. That's right.
But it definitely was more than I thought. So, and folks, for those that are unaware of the standard deduction, obviously everybody's going to get that, unless you itemize, which, as we mentioned previously, some of the changes from the OBBBA, itemizing actually may be a little bit more difficult in the future for some. So you may start to take advantage of this. But for those that might have children that earn income, as long as it's under the standard deduction, they're not required to pay taxes. So I think that's the biggest reason the standard deduction is important for our listeners.
Absolutely.
The next one we got, folks, was changes to the brackets. So if you remember when we recorded the OBBBA episode, we did talk about how the tax rates for each of the marginal buckets were not changing, the rate themselves. However, Judson, the income at which, or I should say the income that is taxed at each level does change. That's changed for inflation each year. Probably the easiest way is maybe just to tell people where the 37% bracket starts. Is that fair? Just to give some perspective on where increases were?
Yeah, I think for most of our clients, that's what we're really talking about. And for a married couple filing jointly, the top tax bracket in 2025 starts at $751,600. And in 2026, that is increasing to $768,700. So you get a whopping $17,100 more at the lower tax brackets, basically.
Yeah. And really everything from there kind of scales down on where each of those brackets starts and whatever else it is. But I mean, again, that's sort of indicative of past years where it's a little bit of an inflation bump. And I think, Judson, maybe before we get to the last couple here, what we know from that and the standard deduction, which are maybe a little bit bigger than normal, is we might actually see something more than $500 to the 401k or maybe the profit sharing. My gut tells me the IRA is going to be $500 because it's always $500 or nothing. But maybe they bump 401k to 24 instead of.
Well, it's at 23.5. So
no, I know 24 there, but then maybe they take profit sharing to 47.5 or something like that.
We never know. We guys, you're on pins and needles, I know, but we will bring it to you the minute the IRS drops it.
Really, I think what everybody really wants to know, Judson, is this next one, which is the change to the phase out for alternative minimum tax.
Huge.
Which is a big deal. And incidentally, it's not alternative, nor is it minimum.
Yeah. You may want to pull over when we talk about this one.
This is the most inappropriately named tax of all time. Never mind, we're not going to do AMT. I just wanted to point out that it's not alternative or minimum.
I thought you were definitely going to go to the qualified transportation fringe benefit limit.
That was where I was going next. Yeah. No, our last one is we actually officially have the estate tax exemption. We already kind of knew, but again, this is an article today on the IRS website that officially puts it at
$15 million.
So 15 million, which is
$15 million.
what was teased anyway in the OBBBA. So we kind of already knew that. But y'all, we have a ton coming with HSA limits, IRA limits, 401k, profit sharing, Social Security, all those things. And we will give it to you over the next few weeks.
Yep.
All right. Let's go back to the basics.
Back to the basics. Or as you said last week, the timeless lessons that we have been teaching here at Kane Waters for 41 years for some people, less than that for others.
Indeed.
I actually had, because I know you guys all want to celebrate this, I had my 21st anniversary at Kane Waters on Saturday, of all times. I got an endless amount of text messages and calls and gifts. My phone really just didn't stop ringing.
Well, you got so many lauding praise on you for the 20th, despite
That's
you
true.
wanted it. You wanted it from all of us. And
Yeah.
we were like, yeah, okay, cool. Most of us are 35 or whatever the most employees are around here. No, 21's big. And Judson, I think one of the reasons we want to go back to compounding is I celebrated my 18th. And you and I both now have been working with clients for 15, 20 years. And I mean, the reality is that when I've told several clients this, when I originally started teaching 1-to-1, 2-to-1, 3-to-1, which we'll go over in a second, when I started teaching it, I've told clients, to be honest, like I had never actually seen it work.
Yeah, we weren't lying. That's the lesson after
really
18 to 21 years is we weren't lying.
That's really it. But I mean, truly, like I had never experienced it. You had never experienced it. We kind of went on math and the older partners around here telling us that it
math
worked.
and trust.
And now here we are.
Thank God math isn't a lie.
That's right.
Because we would be in big trouble.
Math is math. Now here, 15 to 20 years later, you and I are actually seeing our real client scenario where they started with zero and they are compounding like nothing else.
That's right.
It is just the growth that they are getting. It's $500,000 a year or $1 million a year or whatever else it is. And we're even seeing that in our own financial plans.
Yep.
And it's just a reminder. We wanted to go back and say, how powerful this machine actually is.
We wanted to go back and say, you're welcome.
Right.
That's it.
For not lying to you about math.
That's right.
All right. We're going to start with some fun stuff and then we're going to go to 1-to-1, 2-to-1, 3-to-1. We should start, in case you wonder, you're wondering, listeners, the concept of compounding is best defined by this quote by Ben Franklin. Money makes money, and the money that money makes money.
Yeah.
Right?
Totally.
Money makes money, and the money that money makes money.
That is basically 1-to-1, 2-to-1, 3-to-1 simplified.
That's right.
And not so simple.
That is, there are tons of things out there. I love Buffett's, like, you can't make a baby by making, by getting 9 women pregnant in 1 month. That's a great one. But conceptually, the power of compounding is time. And maybe my favorite quote on this is from Morgan Housel, who we've talked about his books on here before. By the way, his new book just dropped on Tuesday. I haven't read it yet, but I will, and we'll bring it to you guys probably in a book review. He says, all compounding is returns to the power of time. Whoa, I'm doing math. Yep. Remember powers?
Oh, I do.
Yeah. Is returns to the power of time, but time is the exponent in the equation. So that's, to me, what you want to maximize, right? And I love that concept because as we talk here in a second about 1-to-1, 2-to-1, 3-to-1, that is at its core, it's just waiting for time. Patience, patience, patience.
Well, I think that when you combine that, and really if you go back to, the lessons that, we've taught here forever, it's time, but then the second most important factor is amount, which is what we call savings, right? Because you can wait forever and not save and you still have nothing, right? So it's the combination of these two things that really are what has, made the magic for our client's financial plan, right?
Yeah. And no matter what, early on, clients will get so concerned with the rate of return or whatever else. And it's like, 9% of zero saved is zero return. 10% is zero. I mean, it literally does not matter.
Yep.
You have to save and you have to you just have to sit and wait. And again, it goes to the whole 98% of Buffett's net worth was built after he was 65 because he seeded it with all this capital and then he just waited. So Judson, let's go back to 1-to-1, 2-to-1, 3-to-1, and sort of explain what that ratio is. So again, it's a ratio of 1-to-1, and then 2-to-1, and then 3-to-1. If you've never heard that before, Judson, what does the ratio stand for?
The ratio of 1-to-1, 2-to-1, 3-to-1 is simply the amount of money that you're earning to the amount of money that you're saving every year. And so, basically what Daryl did many years ago to simplify this for clients is to just boil it down and say, look, there's really three factors in your financial plan. There's amount, there's time, and there's return, right? You are going to define the time based on the time in which you want to be financially free, right? You tell your financial planner, I want to be financially free by this date. And then we can make some return assumptions and we can back into the amount, which is basically your savings, right? And the whole point of this exercise is to help you understand why saving early on to allow the compounding to actually take effect makes sense. And so, you go to this 1-to-1, 2-to-1, 3-to-1, and we use these simple examples with clients when they first come in. Every client that comes into our firm learns this, and it's like, okay, if you save $1, and in your first year you earn 10%, you've earned 10 cents, right? You're at 0.1-to-1. Really simple. Okay. The next year you add $1 to it. You've got $2.10. You earn 10% again. You've earned 21 cents. The power in that second year is, okay, in that second year, you earned 20 cents on the $2 that you have saved. But then something magical happens in that second year. You've earned a penny on the prior earnings. And that's what Benjamin Franklin was talking about, right?
Money makes money, and the money that makes money makes money.
You should make a rap song into that.
It's coming.
Yeah, okay, good.
It's going to be our new intro music after this newest song that we just introduced today.
It's going to be huge.
You're exactly right. That penny is, in fact, where the power actually comes. And at first glance, I think even when we were teaching this to clients years ago, it's like, okay, a penny?
Wow.
Really?
Yep.
Cool, guys. Neat trick. That penny then gets another penny, and then boom, 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 over and over. And all of a sudden it gets out of control. Now, Judson, when we say 1-to-1, so that first year, the savings or the earnings is 0.1-to-1, right? It's the 10 cents plus what we saved. In year 2, right, now all of a sudden we have 0.21-to-1 because we only use the dollar we saved that year. So Judson, when they equal 1-to-1, simplistically, what the heck does that mean?
It means that you've saved long enough. You've saved that dollar long enough to where your earnings are equaling your savings, right?
Yeah, so 50% of the growth of your assets in that year was a result of previous savings. And if you put it in those percentage terms, it's like it gets pretty out of control pretty quickly, right? Because there's going to be a point where now all of a sudden, all of the money that's being added, almost all of it, 95% of the money that's being added is your previous savings. And that's when the compounding really kicks in.
And the doubling happens in much shorter succession after you hit that 1-to-1 point. So, there's this old saying again that we've been saying here for many, many years now. And we say the first 1-to-1 always wins, right? Because the first 1-to-1 is the first 1-to-2 is the first 1-to-3 and really all that harkens back to is don't delay the savings, and we talk about this all the time when we talk about debt pay down, when we talk about, discretionary expenses, all of this kind of stuff. It's like, we want to help our clients do all the things, but first and foremost, we want to help you hit your financial goals. And so we're going to carve out that savings as early as we possibly can.
Yeah, because math is math. And so when we know the case to be that the earlier you can save and then let the exponent of time take it, the more freedom you get long term. So everything we do when we teach here is structuring your financial plan early on to save. That's it. The reason we want to cut taxes in your plan is so we can save more. The reason we want to extend amortization or whatever else it is so we can save more. It's all about that. The way we structure all of our transitions, it's all about saving. Because it takes advantage of this. And this is, again, two guys that have now been doing it long enough to say, not only have we mathed it, not only have people told us about it, but now we've actually experienced it ourselves, and it's 100% true. And it's 100%. More powerful than I actually thought it was going to be.
Yep.
All right, so 1-to-1 is great. First 1-to-1 wins. And just to give you some numbers very quickly, listeners, 2/3 of your retirement assets, when you hit 1-to-1, is done. So what the heck does that mean? The money that you have saved up to that point now is going to represent 2/3 of all the money you will ever have for retirement. And that's a huge lift because basically, if you stop saving at that point, you could have 2/3 of your retirement lifestyle forever right there. But Judson, what happens if we keep saving and all of a sudden we get to this point where it's 2-to-1, right? So at 2-to-1 now, our savings is two parts, or I say our earnings is two parts to our savings of one. But something starts to set in because that's where a lot of you and I's clients are. It's a little confusing because the compounding hasn't truly kicked in yet, right?
Yeah, so this is something that we'll often call the expectation gap, right? Because money doesn't grow linearly, it grows geometrically, which basically means that, we are just getting to the point of our compounding heating up. And so what happens is that it takes a while to heat up. So you get to the point of this 2-to-1, and if you look at like a time graph, what you often start to feel is that you're behind on where you think you're going to be in a shorter amount of time, right? So, you may look at your assets and say, hey, you said, Hunter, that when I retired, I was going to have $10 million. And here I am at, 2/3 of the way through my retirement plan, and I only have half the assets that you say I'm going to have. I have $5 million. That makes me feel behind.
Yeah, and to use a real life example, my client on Friday is they're right at the expectation gap. So she started with me right out of residency at 29 years old. She's been practicing for 15. So she's in her middle ages. I'm not going to say her name because that would be very rude, Judson. And you're not going to pry it out of me either. Her husband listens on a regular basis. So she's in her mid 40s now, and she's got 15 more years until her retirement age of 60. So we're sitting there and they've done well and they saved and they've done the things that they need to do. But she's like, okay, well, what assets am I going to have at 60? And so we pull up our software and the answer is $12 million. And she's like, well, hold on a second. I've been saving for 15 years and I've got 2.5 million. And you're going to tell me that in the next 15 years, that 2.5 is somehow going to turn into 12. And I'm like,
pretty cool, huh?
It's math.
Yeah.
But again, that's the really, really difficult thing for her to understand right now because that expectation gap is most acute at that middle point.
Which if you don't, and the reason it's so important to understand is if you don't have a hunter that's telling you, yes, this is actually true, and we've seen this time and time and time again, is if you're feeling that expectation gap, if you're feeling behind after those 15 years and you feel like you have to catch up in some way that you can control, that's when people often make bad decisions. I have to get uber aggressive. I'm going to put my money over here and do X, Y, Z. Or sometimes it's even just throw your hands up in the air and be like, well, this isn't working, and screw it.
It's taking me 15 years to get to 2.5. So 15 more years, I'm going to have 5. And it's like, no, that's not actually how this works.
Yep.
And I actually think what's the really cool part about this is a lot of the reason we were talking about this is that, they have, as their children have aged, they have some goals that they wanted to go out and do. And they were like, hey, we've been saving, we've been doing all these things. If we continue to save at this level, do we need to save more? Because at first glance, the answer would be like, well, we're going to have to. We're way behind, right? And I was like, no, you don't have to save anymore. In fact, the money that you were thinking about adding to your pile, now you can just go do those things with your kids. And you could see just the pressure relieved from her visibly because it was like, I can't believe it. I'm basically done. I've just got to let time take its hand or take over from here. It's like Jesus, take the wheel.
There you
Tom,
go.
take the wheel. Take the wheel. There's a song there, right? Along with money.
Along with money,
makes money.
Okay. Money on my mind.
Money. That's a good one. Okay, so we're at 2-to-1. Judson, we got one more to get to, and that is 3-to-1, which you've got some clients button up against this one for sure because it
100%.
Generally is 18 to 20 years in.
Yeah,
so,
it is, but also, if you really look at, if you look at the past 5 years outside of 1 year, we've had we've had returns that have exceeded what we estimate for our clients. And so I have a lot of clients that are right in this time frame, and they're actually seeing it, right? They're actually seeing their assets accumulate at a much more rapid pace. And obviously we show them this and we go through this. But it's been fun to watch, right?
Yeah, past performance is not indicative of future results.
Truth.
You're exactly right. It is fun. And think about it, 3-to-1, folks. Your earnings are 3 parts to your savings of 1, which means 75% of the dollars added to your pile that year were something you had already saved for. And that's an incredible moment. And what we say at 3 to 1 is anything you save after 3 to 1 is personal preference. Because really at that point, it doesn't have time to take advantage of compounding. And you've done all the heavy lifting already. And it really does get to be fun then, because the whole I'm done is just a really freeing time for folks to be. And I think that at the end of the day, Judson, like when you think about the way this math works, and if you really follow the plan and you hit these, 1 to 1 by year 10 and 2 to 1 by year 15 and 3 to 1 by year 20, what it really frees up is your children might be leaving, or you might be bringing in grandchildren into your life. It frees up the most incredible thing in a financial plan, and that is flexibility.
Yep.
Flexibility to truly go do whatever you want with your earnings each year, because all of the savings has been done and is growing and compounding on the side. And that freedom to say, man, I can go do whatever I want at this point is really why we have financial planning in the first place, right?
100%. And then the last thing, Hunter, is, just to tie it in with last week a little bit, because last week we talked a little bit about the 5 savings buckets. And one of the things we said is that, and one of the reasons that we promote tax-free and tax-deferred savings is because you don't have to pay taxes on that earnings every year. And essentially what that boils down to is that allows you to help the compounding, right? And so, by I can't talk anymore. I'm done, apparently. By coupling the savings with the additional growth by not having to pay taxes on it every year, you can just really get that much further ahead. So I just had a really quick example of like, hey, if you are one person maximizing your 401k plan in 2025, you one person can put in $70,000 into a 401k plan, right? Between your deferral and your profit sharing. Okay. If you do that into a tax deferred environment for 25 years, let's say, okay, and you earn 8%, at the end of that 25 years, you have $5.5 million. Okay. If you took that same $70,000 and you put it into just a regular non-tax advantaged account, the only difference is that you have to pay taxes on the dividends, the interest, on any capital gains for assets that are sold. And so you're paying taxes along that time. So what I basically did is said, hey, if you have to pay 25% taxes on that growth, your earnings are 6%, not 8%. And what's the result?
Huge result. The difference between the two piles is $5.5 million if you've done it inside of a qualified plan at 8%, and only 1.5 if you've done it at 6% outside because of the taxes. I mean, that's just it's a gargantuan difference between the two. Especially, yes, you have not paid taxes on the money when it comes out of the 401k, but you have allowed that extra 2% every year to grow and compound. And even once you pay the taxes on that money when it comes out, you're left with $3.5 to $4 million compared to 1.5. All you've done is you've taken advantage of the arbitrage the IRS has given you, which, by the way, is why they cap what you can put in there, because it's an incredibly powerful thing. And so thinking about layering in the whole part of compounding, saving early so that you can actually take advantage of time, doing it in the right account, and also compounding at a really steady rate is what brings success to financial plans, period.
Yep. And any naysayer that says, hey, that difference is 37.5% greater in the tax advantage account, any naysayer is going to say, well, if you take it all out and you pay 37% taxes on it, then you're at the same place. Well, yes, but nobody's dumb enough to take it out at one fell swoop. And so what happens is that compounding and the tax advantage continues on for basically as long as you live, and you're only taking out what you need to live on. And so naysayers, you suck.
Clearly.
Right.
They're idiots is what you said.
Yeah.
Yeah. Well, before we wrap up, for those that joined us in Amelia Island 2 years ago for our annual meeting, we talked about on stage, that compounding even goes beyond just money. And it's a really interesting concept, folks. And I would encourage you to just think through this, but we talked about how everything compounds, right? And Buffett's on record for that. And so is Morgan Housel and so many others. It's not just money, it's news and events and knowledge and innovation. And you think about something as simple as like Edison's light bulb and how that actually built itself on the back of the arc lamp. And so you start to actually see like the power of compounding elsewhere in your life, and it'll prove out to you that, oh yeah, maybe it does work with money, right? Because I think there are a lot of naysayers as well who we are not going to call you idiots, because at first glance, when you think about this concept, you're like, there's just no way. It's not intuitive that something so big could come from something so small. And I think the best way to think about that is like electricity is so massive and it powers so much of what we can do in this world. And yet it came from such a small little innovation back in the day, and another small innovation and another one. And all of these things built toward the fact that we have a fully powered world. And if you think about it in that perspective, while it may not be intuitive, it starts to really resonate that, yeah, maybe like this thing is actually true. And so again, that's why I wanted to go back and cover it. We're both experiencing it in our personal lives and also now with our clients in their financial plans. And we cannot, encourage you that are young enough to just get going and to save as much as you can, as quickly as you can. Don't worry about what it's invested in or anything else like that. Just get it saved and let your time, because that's really the greatest thing you have, sort of take control from there.
And if you need an advocate and if you need somebody to help you figure out how to do that, we got lots of people here that will be happy to do that.
Indeed. All right. Get us out of here.
All right. The best way to keep up with this is to hit subscribe so you never have to miss an episode. You can always go back and catch up on the ones you've missed. If you're enjoying our show, leave us a review. We really do want to hear what you think. It helps us to know what's resonating with you. Got a question, comment, or even an idea for a future episode? Reach out to canewaters.com/wealth. We read these emails, and yes, we actually do reply. And if you want to learn more about what we're doing when we're not behind the mic, visit canewaters.com, where we're helping more than 3,200 clients work towards their long-term financial goals. Thanks for listening to the Accumulated Wealth Podcast, and we'll see you next time.